Hello, everyone. A very warm welcome to you today as we count you down to the end of the 90-day tariff reprieve. I'm Senior Editor Rebecca Byrne here in London. Now, let me take you on a short walk down memory lane all the way back to April 2nd, just to remind ourselves of how all of this got started. Because it was back on April 2nd, a day that President Trump described as Liberation Day, when he announced these very high tariffs on US trading partners around the world, including what he called reciprocal tariffs on those countries with very large trade surpluses. Of course, the markets did not like this at all. The S&P 500 and MSCI World Indexes dropping more than 10% in the aftermath. Credit spreads widened, bond yields dipped a bit and then spiked higher, and the dollar fell as well. And it was this general sell America theme that prompted President Trump to reverse course and implement this 90-day delay to allow some time for trade deals to take place, all the while, of course, keeping that 10% baseline tariff in place. But of course, over these last 90 days, we haven't seen many trade deals. We had one with the UK just a few weeks ago. We had one with Vietnam. We've had a tentative truce with China. But we really haven't had a flurry of deals. The art of the deal, well, it seems like the only thing that's really closing is the window for negotiations. So today we're going to be taking a look at what will happen when that deadline is up. And we have a panel of experts to do that. They include Inga Fetchner, who is our senior economist and trade expert in Frankfurt, James Knightley, who is our chief international economist in New York, and Porrick Garvey, who is our head of research for the Americas, also in New York, with a focus on the bond market. If you have a question, there is a questions tab at the top. Please put it in there and we'll get to them at the very end. There is a chat function as well. Please be reminded that this is a public forum and everything that you write will be seen by everybody else. But with that said, we want to start things off with a poll for you. And I think this is a really interesting one. Because we really want to know what are you most worried about? What are your biggest concerns? So what aspect of the current international trade environment concerns you the most? Is it the risk of higher tariffs and adverse financial market response? The risk of sector-specific tariffs and the legal uncertainty, the threat of retaliation by US trading partners and the potential escalation, or renewed US-China tensions? And the results are taking a while to come in. Right now, it looks like 50-50, but we'll see how that pans out. But Inga, I suppose what everyone wants to know, this deadline's been extended now, hasn't it? We thought it was going to happen in 2 days' time. Now it's not going to happen until August 1st. But are we going to see those tariffs that we saw on April the 2nd reinstated? Or given the market reaction last time, do you think we'll get some sort of extension, or what do you think is going to happen?
So what we can say for sure is that the tariff roller coaster ride is going to continue. So indeed, we did get another extension, at least judging from the comments made over the weekend by Lutnick, by Trump himself. So now the deadline has been moved from 9 July to 1st of August. So we have some 3 more weeks in order to get trade deals or trade agreements done. There's more room for negotiations. There's also more room for a country to, which is not happy with its set tariff rate, to enter negotiations if it hasn't done so. So oil is still hanging in limbo, and we are sort of back to square one because we did get, in fact, another extension. We had, first of all, 2nd April announcement, which was moved to 9 April, now to 9 July, and now to 1st August. So what we know for sure is that it's still an uncertain environment, that we still need lots of flexibility in terms of how goods trade is done. And that also the US administration, however, is also quite flexible in setting those deadlines, because, I mean, Trump has stated multiple times that there wouldn't be any extensions, that the 9 July deadline would be sealed in stone. And now we did get this extension. I mean, from the start, it was sort of clear that those 90 deals in 90 days would not be possible. So now we have some more time up our sleeves. But overall, we're just going to stay in this uncertain environment.
Now, the Trump administration seems to have scaled back its ambitions for comprehensive trade deals. According to the FT, it's now looking at narrower agreements in principle. Are these deals likely to be economically significant, or are they more likely to be sort of symbolic in nature?
Yeah, I would definitely say they're rather symbolic in nature. So they might look good on paper, or might not even look good on paper, depending on the details, because the details sometimes are really scarce. I mean, also with the UK-US deal or agreement, it's pretty scarce indeed. We don't know anything really about the Vietnam US deal. We haven't had anything in writing just yet. Also regarding the trade truce or the tariff truce between China and the US, we don't have anything in writing. So it still lacks lots of details. And what we can say now is that the 10% baseline tariff is here to stay. So the US isn't backing off its protectionist stance. But also regarding other potential trade agreements, I would say they're rather tariff reductions, they are rather tariff manifestations, so really locking in this 10% baseline tariff, some higher tariffs for other countries, also some higher sectoral specific tariffs. So we are definitely going to stay in this higher tariff environment. It's also the question, what is really going to happen in real life? So when you have this deal on paper, are really those investments going to flow in, which some countries have promised? Are those countries really going to buy more US stuff? How much are they going to buy? So it might look good on paper, but honestly, we think it's rather symbolic than really meaningful what's coming out of those trade deals or trade agreements, or indeed, say, trade tariff manifestations.
Okay, one of the sticking points in the talk seems to be that the administration has said it's also considering imposing tariffs on critical sectors at a later date. So, and actually, I can see the results of the poll now, and it looks like 15% are most concerned about the risk of sector-specific tariffs and legal uncertainty. Even if countries were able to strike a deal now, that wouldn't necessarily remove the threat of harsher tariffs later on. So could these sectoral tariffs sort of delay the progress or derail the progress on the reciprocal tariff front?
Yeah, I think it's quite important to know that there's still several investigations on the way. So despite those IEEPA tariffs that are largely in place right now, we do have some sector-specific tariffs already in place. Those are the 25% tariffs on cars and car parts and the 50% on steel and aluminium. Those have been done under Section 332, so threatening the national security of the United States. But then, of course, we have way more investigations underway, for example, in copper, pharma, lumber, shipbuilding, cranes, etc. So there's still a lot going on, and those investigations, they always require really profound investigation. So in contrast to the IEEPA tariffs, so those International Emergency Economics Power Act tariffs, they do need or require those profound investigations. Usually they last for 9 months. Of course, it can be speed up, but the US Commerce Department needs to look into it. The USTR needs to look into it. So they're really based also on different, based on legal opinion or options. So we do believe that more sector-specific tariffs are going to come in, probably after the 1st August deadline. So when those IEEPA tariffs have sort of settled, when it's all sort of sorted out, when some trade deals have been closed. Of course, when you look at the US-UK deal, there are some provisions which already mention potential sector-specific tariffs, that the UK would potentially be spared from those sector-specific tariffs. There might also be in those deals some negotiations reducing the tariff rate for those sector-specific tariffs. But overall, we don't think that the tariff threats or higher tariffs are over. So there's still a lot more coming in. And I think that the problem, of course, is also sort of this legal uncertainty, because the IEEPA tariffs, they are under scrutiny, so they have been challenged in court. One court has said that Trump did indeed overstep his powers by using IEEPA. Now it moved to the US Courts of Appeal. There will be a hearing on 31st of July. probably a ruling in August or in September. So regarding IEPA, a lot is still uncertain about those section tariffs. So especially section 332 and section 301. They have been around for many years, so they have been used before. They have been used under Trump's first administration. They have been used under Biden. They have been extended under Biden. They're now once again being used by Trump. So we do expect, especially those tariffs, those sector-specific tariffs, relying on those specific sections to intensify.
And what about potential retaliation from US trading partners? This is a big concern from our audience. 31% are concerned about this retaliation, but of course the plurality, 42%, are just concerned about the risk of higher tariffs in general and the market reaction. But is there a chance that we could see new trade wars, perhaps with the EU and others?
Yeah, I'd say it's definitely not over. So I think those tariff threats are going to linger around for the whole US Trump administration. He's always going to use tariff threats as leverage to get concessions out of countries. He can always say, okay, I'm now going to raise the tariff rate from 25 to 50 or whatever. So if he's not happy with the trade practices or the general behavior of a trading partner, he can always threaten more tariffs. And indeed, so Canada already opted for retaliation, some mild retaliation. The EU has positioned itself also for retaliation, although of course, as long as there's no deal, they probably won't opt for retaliation. So that still hangs in the balance. But India and China also filed WTO complaints. So I think if there's no deal which is acceptable for both sides, if on the other hand, also new tariffs will come in from the United States, then the partners will retaliate and tensions will heat up. And I think what we shouldn't forget, there's still risk between US and China, also with tensions blowing up again, because we do have this tariff truce. But of course, the US administration, it perceives China as being really the biggest enemy to its strategy. So it might well be that tensions flare up again and that we haven't seen yet the end of tensions between those two countries. And also don't forget that the UK-US deal and also the deal with Vietnam. So those 40% transshipment tariffs, whatever that might mean in reality, so we don't know yet what exactly that's going to cover, but that is also targeting China, and China is of course not happy with the US signing deals that might make it more difficult for China to do businesses. So partners might even need to choose between either doing more business with the US or with China. So we don't think that this whole tariff, that this whole trade relocation, trade reshuffling story is over, and we will definitely hear more from the tariff front in the next weeks, months, and probably also in the next couple of years.
Okay, thanks very much, Inga. We're going to go to James now. But before we come to James, we have another poll for you. And as you know, one of the aspirations of the Trump administration is to bring manufacturing jobs back to America. But we want to know from you, will US manufacturing employment be higher or lower or about the same by the end of Trump's term in 2029? So the choices are higher, about the same, or lower. Submit your answers. And we'll come back to those in just a minute, because there does seem to be a little bit of a delay for me. But James, you're expecting huge swings in GDP as a result of Trump's policies this year. It's created a very unsettling environment for consumers and businesses. How have they been reacting to all of this?
Yeah, that's right. I mean, we obviously saw a negative first quarter GDP print here in the US, and that was because massive front running ahead of the tariffs, sucking in imports from overseas. We're expecting that to unwind in the second quarter. So second quarter GDP should actually be pretty good, probably up around 3% or so, largely because the net export drag becomes actually quite a big boost for the US economy. So I think we have to look through that a little bit and look at the underlying story here in the United States. And there is, I think, a bit of concern about the consumer sector, because that is 70% of the US economy, and it's been the real growth engine for the US economy since the pandemic struck. Now, here we have seen consumer confidence fall quite markedly, and tariffs have played a role in that. There is I think a certain degree of anxiety amongst US households about what tariffs may mean for prices, what that does to household spending power. And there is that caution coming through. And on top of that, there is some angst as well about the jobs market. Although Friday's jobs report held up pretty well, I think there is caution that the jobs story may not be looking quite so robust in the last part of this year and into next year. And then thirdly, there is a cause of concern from wealth as well. We've seen some big swings in equity markets this year, down 20% and then fully recovered. But also we look at house prices as well. And that's housing is the biggest store of wealth for most Americans. And house prices now fallen for the last 2 or 3 months. And there is, again, some caution that we could see more supply hitting the housing market. So, and that depressing prices. So we've got a situation whereby the consumer, which has been firing on all cylinders for the last 3-4 years, is no longer going to be that growth engine. And also at the same time, businesses are somewhat cautious. The uncertain trading environment means that we are seeing the business surveys looking pretty subdued. And there is, again, this sense that could mean that companies focus more on things that they can control when they haven't got that much confidence in terms of where the economic outlook is heading. So they focus more on their costs. And that means pulling back on hiring, pulling back on investment as well. So certainly there is a sense, I think, that the US economy is losing some momentum. And we can see that in the consensus forecasts. At the start of the year, the US was expected to grow about 2.5% this year. Now the consensus is about 1.5%, and it's a pretty similar story for next as well.
Now, the Fed has cited concern about the impact that tariffs would have on inflation. The weaker dollar can't be helping either. But as you've mentioned, the economy is at risk of losing momentum. Does that mean that the net effect will be a fairly stable inflation over the coming months, or could we be facing a form of stagflation?
I think over the last few months, the inflation readings have actually been pretty good. We've been getting 0.1s or 0.2s on the month-on-month rate, and that's the sort of run rate that we need to track out to bring inflation down to the 2% target. But clearly there are worries that we will see inflation pick up in subsequent months. The last time we saw tariffs was back in 2018 with those washing machine tariffs, 20% tariff on imported foreign-made washing machines. And that took about 3 months to show up in the inflation data. So if we think, well, the tariffs came in April, so that means May, June, July. July inflation data is when we start to see it coming through, but it could then carry through to August and into September as well. So we've got this wave that we are anticipating more elevated readings, 0.3s, 0.4s, 0.5s, certainly coming through. So that is a goods price story, though, remember. It's only tariffs are applied to goods. The US is predominantly a service sector economy, and I think that is an important factor that we've got to remember. And in service sector economies, the biggest cost input is the cost of your workforce. And when the jobs story is looking less rosy, wage growth is slowing, and that was, again, evident on Friday's jobs report, then those price pressures are diminishing. Moreover, we've got to remember that 40% of the US inflation basket is actually housing. And house prices, as I say, are starting to drop, and rents are starting to slow quite markedly. So I think that will be an important story. So I think we're in a very different situation because a lot of people are concerned that, as you say, this stagflationary environment, looking back to the post-pandemic environment when the Fed was telling us, don't worry, inflation is going to be transitory. And then, of course, it wasn't. And inflation went and hit 9%. I think we are in a very different environment. The jobs market is not as red hot, well, certainly it's not red hot, as it was in that post-pandemic period. And of course, house prices weren't rising, well, are no longer rising 50%. They're actually falling. So that wage story and the housing story, I think, really critical. So yeah, we're expecting a wave of inflation over the next 2, 3, 4 months or so, but that's going to be short-lived. And we'd be looking for much softer inflation prints for next year.
So President Trump has been pressuring powell to cut interest rates again, as you know, James. After April the 2nd, Liberation Day, the market was pricing in 100 basis points of cuts, but those expectations have since moderated. The jobs report was a bit stronger than expected too. How long will Trump have to wait for his rate cuts?
Yeah, we've got to remember the Fed is a little bit different to most central banks. Most central banks around the world target inflation at, say, 2%, and that's their job. The Federal Reserve has got a dual mandate. It's got to target inflation at 2%, but it's also got to maximize employment. So any risks to the jobs market that does also translate into the thinking. Now, of course, as you say, Friday's jobs report was better than expected, and that's dented the prospect of a July rate hike. Certainly, I never thought that was realistic. But also September, which was fully priced for the first Fed rate hike, is now only got about 18 basis points of a 25 basis point cut priced in the wake of the jobs story. And also, as I say, I think we could be in for a wave of more elevated inflation readings, 0.3s, 0.4s, 0.5s over the next 3-4 months or so. And that makes perhaps a September rate cut a pretty challenging story. Because as I say, the Fed was stung by the criticism when it told us inflation was going to be transitory post-pandemic. It wasn't. I think the Fed will want to see some clarity in the data. So we'll need to see both the inflation numbers starting to soften before they will be comfortable, and also some weaker jobs numbers coming through as well. So it may not be that happens until the fourth quarter. So we're thinking that we're not looking for a July cut. We're not thinking a September cut. We're favouring the fourth quarter story, but it would be December. But it could be that they end up being more aggressive, because I think by December we probably will see more softness in the job story, and the Fed's inflation concerns will be allayed by the data. So we think December and a 50 basis point cut.
Okay, now Trump obviously needs the income from tariffs to offset the bill for his tax cuts, but it's also obviously a strategic move to help bring manufacturing back home. And just going back to the poll, I can see interestingly about half of the respondents say that manufacturing employment will be about the same by the end of his term. But how successful is his policy likely to be? Tariffs alone are not going to fully plug that hole left by the tax cuts. And if tariffs remain at 10% globally, how much is that really going to encourage companies to reshore?
Yeah, I think when we look at tariffs, I think we've got to sort of accept that Donald Trump's view is that this is a tool that can achieve multiple aims. So firstly, it can be a tool to achieve diplomatic change on the international stage. So, for example, one of the first wins from tariffs was, of course, the border security guards that got put on the Mexican border and the Canadian border by their respective governments. So that delivered change. Secondly, of course, he thinks that it is a way of raising money, and that does help to at least partially fund the tax cuts that are part of the One Big Beautiful Bill Act that, of course, got signed into law on Friday. And then thirdly, it is a tool that he thinks can ensure manufacturing in the US becomes a more competitive option for companies to do. So, as I say, it's a tool that can achieve multiple aims in his view. Now, will it be successful in delivering manufacturing jobs? I'm somewhat skeptical. I think, even with tariffs, the cost of manufacturing in the US is very, very expensive. The planning processes required, the energy infrastructure that is needed, the transport and logistics infrastructure that is required to facilitate this is significant. There's a lot of investment required. So I'm a little bit skeptical about quick wins on this. It may well be that he's focusing more on the security and intellectual property protection and technology protection that this can incentivize the reshoring of. I think we will see reshoring of high value-added, highly automated production to the United States. But for the mass production, I'm deeply, deeply skeptical, because I just don't think the costs add up to deliver the benefits. I think it's still going to be cheaper to just pay the tariffs than to deliver on that. So I can certainly see that there being some wins in some sectors, particularly pharmaceuticals, particularly technology, particularly defense. But outside of those areas, I'm not so sure.
Okay, thanks, James Knightley, very much. Should we go over to Porrick Garvey now for a look at the bond market? But first, another poll for you. Let's see how fast our speedy producer can be at getting this poll up for you. We want to know where will the US 10-year Treasury yield go in the coming months? It's currently 4.35%. Will it stay below 4.6%? That was the peak on April 9th. Will it go above 4.6% at some point? I'll come back to that as I have been doing. But Porrick, it was arguably, of course, the turmoil in the bond market that made Trump reconsider his tariff rollout. Trump said he'd been watching the bond market and that people were getting a little queasy. And since then, some calm has been restored, but the question is how sustainable is this current calm given the looming deadline?
Yeah, it's quite a remarkable calm, Rebecca. But just briefly to go back to that crazy day on April the 9th, I mean, we had a 75 basis point rise in the 10-year Treasury yield, which is incredible over 3 or 4 days. And we had the 10-year swap rate getting out to 65 basis points. Now, it's worth just dwelling on that for a moment. 65 basis points over the 10-year SOFR rate for 10-year Treasuries tells us that the US Treasury is issuing 65 basis points higher than they would if they were a true AAA rated credit. So that's the context, and that was shooting higher at the time. Now, the other issue back then is that Trump was all in, and that reference to queasiness suggests that he was persuaded to go on pause. Now, if we go forward, Rebecca, I think this marketplace is in a mood where it's not prepared to presuppose a bad outcome. I think the marketplace does sniff a bad outcome, but it's not going to discount it right now, it appears. So we're going to have to see them. I was watching very carefully when we had the UK deal and the deal with Vietnam. Very different deals, both of them, and the market reaction was quite minimal. So I think two things here. The market will wait for the news, and then it's probably going to wait for the implications of that news, whether it's in activity or prices, before it really reacts.
Okay. Well, a tariff-induced rise in inflation, as you know, generally poses a challenge for the bond market. But lately, the focus has shifted more towards concerns about fiscal sustainability. Trump's one big, beautiful bill has passed through Congress, and that's going to add over $3 trillion to the debt pile. What could that mean for bond issuance and for overall sentiment?
Yeah, so this is where you have a confluence of influences that we identify as being bond bearish over the next few months. So as you mentioned, Rebecca, we've had that bill passed. The implication of that bill passing is that there is no solution to cut the fiscal deficit. That's an issue for the marketplace. Secondly, that means that there will be sustained issuance pressure. And the third thing to be aware of is that the other thing that happened when that tax bill was passed was the debt ceiling was raised, which means that the US Treasury can now do as much issuance as it wants to do. It has been under wraps since the 2nd of Jan this year because we hit the debt ceiling in the 2nd of Jan 2025. Now, most of this issuance will be in bills, that's true. But the bond market is not stupid. The bond market knows that this is coming out of the curve at some point. And the other thing that's happening in the third quarter, on top of the fiscal issues, is the implication of tariffs on prices will become a reality. So if we go through Q3 and we head for 4% inflation, which is what we think will happen, that's the kind of environment where bond market participants will say, okay, inflation is 4%, 10-year SOFR is 3.8, which is below that currently. We got fiscal issues, issuance issues. It's hard for the bond market to regard that as being a bullish environment.
Okay, just looking at the poll results, I don't know if you can all see them, but we asked where will the 10-year Treasury go in the coming months, and it's pretty evenly split actually. 48% saying it will stay below 4.6%, 52% saying it will go above 4.6%. Porrick, as James mentioned, the Fed will likely be cutting interest rates later this year, possibly down to 3.25%, 3.5% range by next year from sort of 4.25%, 4.5% now. Could this bring down long-term rates as well, or does it just mean a steeper curve?
Yeah, it's more a steeper curve, Rebecca. I mean, I'm very comfortable on the front end of the curve. 2-year yield today is 3.9%. So if the funds rate does get down to around 3.25, there's room there for that to fall by 25 basis points. If I look at the 10-year part of the curve, it's currently 3.35. So look, I think 3.35 is pretty close to neutral. And our call for the coming few months is that there is a risk it does get above that 4.60. So that's the viewpoint that we have. And that suggests that the curve steepens from both ends. So front end rates lower, back end rates higher because of all these bond negatives that we've been speaking about.
Okay, and do you see bond markets in Europe perhaps benefiting from this sell America theme over the next few months?
So I've I'm not sure if it's provocative or flippant, but I've developed this term which is contrary to sell America, Rebecca. It's called buy America back, and I coined that phrase because that is in fact what has happened since the pause was instigated. You know, as discussed, we've had a remarkable calm on the bond market, and you know, at the beginning of this webinar, you threw up a chart of the equity market index, which is at an all-time high, which is remarkable, really. So for Europe, you know, I could paint a picture where this could turn out to be positive for Europe, but it's quite a complex web. You would have to have a material de-dollarization process, and it would have to be accelerated. I think there's no dispute that there is an ongoing de-dollarization theme. It's been there for the past couple of decades and probably continues. But the question is, how damaging is it? And you know, our gut feel is that, yeah, we see it, but it's not necessarily critically damaging for treasuries. And consequently, if that's the case, we shouldn't see a significant flight into Europe. And the other thing that Europe is grappling with, of course, is from many European countries, the promise to increase defense spending, which is not for free. They have to issue as well. So there's a confluence of indicators out there which suggest that there could be higher yields than expected over the next couple of years, and not necessarily a boon for European bond markets.
All right, thank you very much, Parik. We're going to go to your questions now. They are coming in. We have one that is asking, possibly this is for James or maybe Inga as well, how are corporates adjusting their supply chains?
For me, I suppose. Yeah, at the moment, we're seeing quite a lot of volatility really in the trade numbers. I think there is this caution. I mean, I think the key takeaways that we had from the latest earnings season was the lack of guidance on revenues and profitability. And as I mentioned, when you get that sort of lack of clarity there, companies do tend to focus more on their costs side of things. And that's why we are concerned about the outlook for investment, the outlook for hiring as well, and the potential for some job losses in some sectors. So that's what my key focus is on. In terms of supply chain management, it's immensely tricky because, again, we just do not know what the end point is going to be. And that, you know, we're going to get this announcement at midday today about these letters going out to 12 to 15 countries about what the dictated tariff rate will be on them. And then August 1st, we're going to be seeing, again, these deadlines for more of the agreements coming through. So I think until there is some clarity, companies are just going to be naturally very, very cautious as well. And that, to me, implies, you know, that we see, you know, companies being just very, very cautious. So I think we just see this natural loss of momentum coming through. And that's my real concern about what's going on here.
Okay, another question actually, perhaps for you, James. Someone wants to know, is there a level of tariffs that means Trump's tax bill will break even? But I guess this is kind of tricky, isn't it? Because it's not just about measuring how much money is coming in from tariffs versus what the tax bill is giving out. It's sort of, there are all sorts of macroeconomic effects from this, from the tariffs, sort of, you know, reduced employment, higher prices, reduced consumer demand, lowering the tax base, reducing income taxes. What is your view on this?
No, that's right. I mean, there's so much uncertainty tied to all of these things. In general, it's sensed that the cost of the One Big Beautiful Bill Act is going to be just about offset by the revenues gained from tariffs. And of course, we've got to remember those Department for Government Efficiency spending cuts as well. So that's where we roughly see it. These are just about offsetting. But the problem is, of course, the starting point is a deficit of 6.5% of GDP. So this does nothing to actually get us to a point where the fiscal position of the United States improves. And the key takeaway I would take from the One Big Beautiful Bill Act is that the fiscal thrust, as it were, is negligible. This is actually going to be quite a big constraint on the US economy, because the bulk of the One Big Beautiful Bill Act is just merely an extension of the tax cuts that are already in place. It just prevents a massive tax hike that would have been hugely damaging for the US economy next year. So we get basically all the bad news with no upside from these events in terms of the thrust, the influence on the growth story for the US economy. And that's why you look at the consensus numbers right now. And as I say, for the start of the year, it was for the US to grow 2.5% this year and next. The current consensus is about 1.5% growth for this year and next. So the net overall effect is knocking about a percentage point of growth for both 2025 and 2026.
Okay, maybe one for Inga, because we've had a couple of questions about the damage to EU companies. And Liz wants to know, what are you hearing from EU companies? Will they be able to live with the 10% baseline tariff, which is actually 10% on top of the tariff they already pay on their various exports? Will they absorb them in margins or pass them on to US importers and consumers?
Yeah, I think it's probably both. So what we're seeing right now is, first of all, that lots of companies also use those warehouses in order to store the inventory. So it's not necessarily that all companies already pay those tariffs, especially big companies do have some ways to not circumvent, but to at least delay tariff payments. So that we should take that into account. So not just because this tariff is in place, it doesn't necessarily mean that companies exactly do pay exactly this tariff. So especially big companies to have more room for maneuver, they can sort of have options in place where they can at least reduce the tariff burden to some kind. Let's say the 10% baseline tariff is doable, but what we've heard is that 20% tariff or even a higher percentage could be damaging for certain sectors, especially focusing on alcohol, focusing on Italian, French wine, etc. So they are even higher tariffs. So they have said that could be damaging also for food exports. For pharma, of course, it depends how dependent is the United States on these certain imports. That's also always playing. We do need to take that into account as well. So the 10%, I'd say, is manageable overall, but the higher it gets, the more tricky it gets. And that's also the reason why those companies really try to get the tariff rate to, let's say, at least 10% and not higher. And for example, for the steel and aluminium companies, of course, that is quite damaging. So the 50% tariff, that is quite damaging. For the car companies, the 25%. It of course depends. It depends how high the demand is in the United States. So for example, Porsche, Audi, who don't have companies, who don't have manufacturing sites in the United States, there of course it depends whether consumers still want to buy those goods after all or not. So it sort of depends. Right now, it's rather taking a bit into the margin, but also passing it on to consumers. But overall, it might, the longer it drags on, probably the longer it also means that the end consumer is going to pay for the tariffs.
One final question maybe for you, James, again. Are US companies trying to boost imports to get ahead of the 90-day tariff delay?
Well, we've seen huge volatility in the trade numbers. We had the chart earlier showing you the surge in imports and then the subsequent sharp drop back in imports as well. And I suspect we will see quite a lot of volatility around these trade data over the rest of this year. The ebb and flow on news on tariffs is going to incentivize companies to try and get ahead of things and get a subsequent reversal as well. So that's going to make forecasting GDP growth very, very challenging when you've got such big swing factors coming through. But yeah, I think that we will see lots more volatility and lots of companies trying to minimize their costs in terms of avoiding tariffs as much as they possibly can.
All right, thank you, James. Thank you, Porrick. Thank you, Inga. That just about wraps things up for us today, but thank you so much for joining us. You may have noticed things are looking a little bit different. We have a new platform for our webinars here. And what this means is that all of our webinars will be available afterwards on our Think website at ing.com/think. So who needs Netflix when you have an ING webinar on demand? Tell your friends and colleagues and join us next time.